Have you ever felt uncertain about the legal side of syndications or wondered if you're truly protected as an LP? In this episode of the Passive Income Playbook on the Best Ever CRE show, we're breaking it all down with insider insights from a top syndication attorney. I'm your host, Pascal Wagner, and today we're joined by Bethany LeFlam, a leading SEC attorney who's helped countless syndicators structure their funds. Bethany has been behind the scenes on deals that have raised millions of dollars. Yet, interestingly, she hasn't personally invested in commercial real estate syndications. So we're going to find out a little bit more about why. But if you ever wondered where LPs get trapped in legal terms, what protections actually hold up when deals go sideways, and how to read between the lines in offering documents, this episode will be for you. Welcome to the show, Bethany.
Thank you. Thank you. Good to be.
Yeah. Anything I missed here? You've been in the syndication world for at least 7 years, maybe even a decade.
Yeah, about 8 years on the real estate side. Yeah.
Yeah. Why do you think, I find it fascinating that you help GPs structure deals but haven't participated in any. Tell
Actually,
us
I
why.
yeah.
Okay.
Yeah. So I'm passive in some deals, and I'm also active now in a deal on the hotel side and getting ready to launch a luxury fund. So I can tell you about that. So I am. It took me a minute to decide to become active. On the passive side, what's interesting is I have such a good vantage point because I get to look at thousands of deals, right? And so I can kind of pick. I know what to look for when I'm looking at operators. I know what to look for when I'm looking at fees. I know what to look for when I'm looking at waterfalls and then the different asset classes. So I do have a really good vantage point, and I have taken advantage of it a few times. So I am passive in some deals. And just about a year and a half ago, I did my first syndication on the other side of the table when I bought a boutique hotel.
Oh man, I can't wait. I can't wait. There's going to be a lot of stuff to talk about here. So, first thing, I would just love to kind of like set the stage. For anyone that is new to knowing Bethany, I want to tell a little bit personal story. When I first got into the industry around 2021, and I was starting to look into investing, I went to a conference called the Real Estate Radio Guys: Win How to Win Funds and Influence People. And great conference to learn kind of from the operator side how they go about doing deals. And I met Bethany there, and actually, I'm a customer or client of Bethany's, huge fan. I've paid them to do some consulting, and that's how we originally got to know each other. But how did you get into this niche of doing structuring funds and syndications? Because I know previously you were an EB-5 attorney, and since then you've kind of been in this industry for a while, and you actually just I think purchased or some sort of agreement with Mauricio Raul, who has also been on the show here recently. And yeah, would just love to kind of talk about that a little bit. Can you give us some background?
Absolutely. So I grew up in law. I was actually a litigator for a hot minute. I hated it. I was killing myself, billing 2,500 hours a year, which is just insane, right? On top of a commute from Los Angeles to Orange County and back, which anybody who's familiar with Southern California knows that was like 3 hour endeavor. Easy. So I started there. I branched out from there and I launched that on my own. And I was doing real estate. I'm sorry, I was doing corporate transactions. I was doing mergers and acquisitions. I was doing securities work on the venture side, operating companies, oil and gas, mega deals. So I was doing an EB-5 as part of that as well. So I was working on these huge deals, and I realized I don't love this. This is not what I want to be doing. I actually left the practice of law for a little while and went to set up my own fund. And the fund was this super complicated, brilliantly structured fund that involved EB-5. It involved investing in real estate developments. It involved creating an accelerator for startups with women and underrepresented founders. And so my heart was in the right place. I had all the legal structure down, and it was so complicated that I could not explain it in a way that investors wanted to give me their money. So I failed miserably, right? And it was this epic failure that I tried to keep alive, for years. Actually, after I'd spent all my money, after I was not getting paid anymore, I just kept sort of chasing this loss. And I was trying to figure out what my next move was going to be. Like, okay, I can't keep doing this. I'm going to go broke, right? Well, actually, I was pretty broke at that point. And I was like, I can't keep doing this because, I've got a kid to take care of. So I was looking for my next move and I met Mauricio. And this was in early 2018. And a lot of you who know Mauricio will remember that he wasn't well in 2018. He was sick and he's been out. I'm not airing his laundry. This is something he tells publicly as well. He was sick and he was looking for someone to help him run his firm because he didn't want to be the single point of failure, right, for his firm. And so I said, all right, fine. I will help you because I have a securities background. I can do these PPMs in my sleep. This is actually, once I started looking at it, way easier than the venture stuff I had been doing in the past. And I said, I'll do this for a little while I lick my wounds and figure out what my next move is. But this is not where I end up. I'm done. I don't like practicing law. I don't want to do it, but I'll help you while you figure your stuff out and while I figure mine out. So I started doing deals with his clients and I started meeting the clients and I started doing a little bit more and a little bit more. And there was this one particular weekend. If you know Mauricio, you know he loves to go out and speak, right? And he had gone to some speaking event. And while he was gone, I handled business. We've been practicing for the same number of years. So I was like, I don't need to call him for this kind of stuff. I know how to do this. I handled it. He came back and he was like, well, so and so, one of my top clients, said that he had this issue and you didn't call me. And I was like, did I overstep? I'm really sorry, you know? And he was like, no, 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 no. I've never gotten to go out of town and be not bothered. What will it take to get you to just do this full time? You know, and I was like, you can't afford it. I don't want to do it. I'm not going to do it. So then I kept meeting more and more of these clients. And I'm like, gosh, you know what? It's not this area of law that I hate. It's not law that I hate at all. It was the people that I was working with before. I was working with all these tech bros, which nothing against the trust fund babies, but I really can relate to the folks in real estate that are trying to create something to get out of their W-2 to provide for their families, to create a legacy, to create some sort of wealth that wasn't just handed to them. And again, nothing against that. I hope my daughter's one of those kids, right? But I wasn't relating well and I was kind of treated like the help. And in real estate, especially where we are on this main street business with mostly mom and pop operators, right? We're not talking about giant REITs or private equity and all this. They wanted me to help them create something, right? I wasn't just the help. I wasn't a scribe just writing documents. I'm like, well, this I love. I can help people create stuff. And so I was hooked and I was like, all right, fine, move over. And I just took over. I took over the firm. And then we made that official just a couple of months ago. So Mauricio retired from actually practicing. He's doing coaching now, and now I'm running the whole firm after I swore I wasn't going to.
Yeah, I love how that happened. So to give the audience some context, how many funds do you think you've structured or worked with over your
I mean, we've done thousands of deals. Like we do funds and single asset syndication. So we've done thousands of deals that we've helped people successfully raise money for, or compliantly at least, and to the tune of billions of dollars,
cross
basically raised across.
self-storage, multifamily,
Yeah,
you
boutique
name it?
hotels, developments, laundromats, whatever, right?
Amazing. Okay, so what a great way to set up the conversations. So you've been structuring these deals, and it's interesting. So you mentioned that I want to point out this diversity between the big REITs and mom and pops. Can you talk a little bit more about the landscape that exists out there? So an LP who's maybe done less than 5 or 10 investments can really like grasp and understand the spectrum.
Sure. Yeah, a REIT and some of these other larger backed real estate investment funds, they operate more like Wall Street, right? They're backed by large private equity groups in a lot of cases or large family offices. And so we're talking more institutional grade deals and investments. And institutional grade doesn't necessarily mean safer or better. It just means bigger. And so a lot of the mom and pop operators that we work with are folks most of the time, they're people who have maybe a high to earning job and they want to figure out a way to create passive income from that on the passive side, or they want a way to work their way out of that. And so they start actively investing. When I say actively investing, I mean they're the ones running the deals. We call it sponsors or sponsoring deals. They're doing the work, right, on these real estate deals. And a lot of times they're doing it as a side hustle. They're doctors, they're some other executive who's just like, gosh, if I stop working, if I get sick, if something happens to me, my income turns off and I'm done, right? There's no safe job for 30, 40 years anymore where you just get a pension and you can ride off into the sunset with your family. You have to plan for that better on your own. And so that's what most of my clients are doing is they're trying to create something legacy and something where they don't have to just work until they die. And that's kind of where our culture has gone a little bit is it's work, 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 and then die. And so these people that I'm working with are trying to create more. than that and create freedom without having to deal with the Wall Street side. And there's nothing wrong with Wall Street. I like diversification. I'm not saying don't invest in stocks. I'm not saying don't invest in Wall Street. I'm saying do diversify, do take ownership. And we don't have control over the stock market. We also don't have control over the real estate market, but we do have control over, if we're operators, how we ride out the various different waves and cycles that we've all seen now. If you've been around since '08 or if you've been around now since 21 or 22, we've all seen these different waves. If you're prepared and you have a good team around you, you can ride that out. In my humble opinion, and this is not me giving financial advice at all. I'm not a financial advisor. I'm not a CPA. I'm just a securities lawyer. But in my humble opinion, real estate, I think, is one of the best ways to create wealth.
I'm on board on the train. I'm a little
Yeah.
biased if
Yeah.
probably if you're listening to this podcast. You said something that stuck out to me. You mentioned institutional doesn't necessarily mean safer. And I would love to pull on that thread. I have a thesis where when I was making my first investment, my larger investment, I asked myself, where do the teachers' funds and firefighter pension funds invest? Because those are organizations that cannot lose money. Uh, and those are typically in institutional deals. You don't see these large pension funds investing with mom and pop operators. So that does not mean an institutional investor by default is safer. But when you say that statement, what do you mean?
Typically, I mean, we've all heard the phrase higher risk, higher reward, right? And so, can some of these smaller deals be a higher risk? They can be, and you can then possibly get a higher reward. You're going to see these larger, the teachers' funds and the unions and that sort of thing. You're going to see them do a safer bet, and that usually means a more moderate return with at least an operator that has a track record that they can at least point to. But if you've ever seen any of our documents, any of our pitch decks that we've approved, you see us have the disclaimer that says past results are not indicative of future returns. We don't know, right? Now, if they have a track record and it's institutional grade, could it feel safer? Yeah, because they've done it a bunch of times before. It doesn't necessarily mean that. And in fact, I would say that some of the mom and pop operators that I've worked with, some of them can be cowboys, sure. But some of them, I mean, this is their whole family's retirement. They are going to be such good stewards of your money. They're doing the diligence, they're doing the underwriting. It's just one at a time, right? Some of these bigger funds, you're looking at massive portfolios. You can also spread risk across massive portfolios, sure. But you could have one runaway deal with a mom and pop operator that could get you way better returns. And it's somebody who is, the steward of literally everybody in their family's retirement money. I'd put my money there. I think that if you in fact, I have put my money there. If you are doing diligence on deals, I think that the operator is the most important part of the diligence, more important than the property, more important than the underlying investment, because you want to know, is this person going to be a good steward of my money as though it were their own or their family's money? I think
I'm
that
with you. I'm with you. I think that is common. It's said commonly. Trust the operator. If you've listened to enough podcasts, operator matters first. I would love to get into a little bit of a discussion. When you say someone who's probably managing their family's retirement they're probably going to be a good steward of their capital, and I think I agree. Think one of my does that. Do you find that you invest with those types of operators? Like, how many deals does that type of operator need to have done in your eyes? As someone who sees thousands of deals, what are your minimum requirements?
that's a good question. And I typically will passively invest. I do want to see a track record of the lead sponsor of successful deals, 4 or 5, maybe more successful deals. I will say this, and again, I am not this is what I've personally done in my investments. I'm a lawyer. You're going to hear me say these disclaimers because I don't want a soundbite to be like, she said to invest in you. So how I personally invest. I do want to see some success, but I also don't mind seeing a few failures and then how they overcame failures. In fact, I prefer that they've got a few failures under their belt because I don't want them learning on my dime, right? And I want to see, how did they overcome those failures? How did they handle it? Did they put their head in the sand? Did they stay in front of it with their investors? If they did a capital call, was it a well thought out plan, or did they plan ahead to not have to do a capital call? Those are the kinds of things that I'm looking for. It's not a deal breaker for me if someone has lost a deal. right? I mean, it's happened. If you're in the market long enough, something bad's going to happen. You might not lose a deal, but something bad's going to happen, right? It just does. If they've been sued, I want to know why and how'd they handle it. And again, not a deal breaker if they've been sued, because if you're in this long enough, you're going to get sued. You just are,
Right.
you know? And so I want to know, how do people deal with adversity? How do they overcome the tough times? Because that is most important to me. Everybody can be a hero when it's good. In 21, everyone was a freaking hero, right? Everybody, you could trip over a property and make money, and everyone's like, oh, I'm a genius. How did you handle 22, early 23? That's what I want to know, you know?
Yeah.
So to me, when I'm doing my diligence, I ask the really tough questions, and your listeners should too. And if an operator gets defensive when you ask the tough questions, run, because you should want to be with an operator that wants to answer those tough questions. Like, yeah, I learned, right? I failed miserably, and here's how I handled it. And now I know better. So now I'll do better. And I think that that's more important to me than always winning.
Do you, I imagine, so one thing I like to talk about is that when I first started, I didn't know what documents I could ask for.
Yeah.
Now being a little bit further along in my journey, I've done 20 investments. I now have no shame in asking for documents like, can you show me a document that tells me all of the loans in your portfolio and in a spreadsheet, clear and easy to read that I can look at, and if they don't provide it, I'm happy to walk away. I imagine that as an attorney, you must have an even sharper edge. I'm gonna go ahead and say it. You probably have a sharper edge on types of documents you like to look at, and if you see ppms structured in a certain way that it's a red flag, or could you shed some light into what you think those might be?
Yeah, yeah. I do ask for and want to review everything in the portfolio. And if they're going to show me a track record, I want to know, first of all, is this everything? And if it's not everything, what's missing and why? Right. And I will only accept answers of, oh, that was all before whatever date we started here, and just because it's too many. Okay, that's fine. Or, hey, you're interested in multifamily, so I'm only giving you the multifamily deals, but we have a whole portfolio of mobile home parks too. That would be acceptable, a reason, but not, here's the ones that performed really well, and that one was kind of a dog, and so I don't want to leave it in there. First of all, that's a violation of securities law, so I'm going to call that out, and I call it out for my clients as well. So there's that.
Zinger.
Yeah. Now, and I will say this, again, because of my unique vantage point, I do only invest with people who have used our firm to do their offering, because I know the deal that way. And so I get to look at everything. But I kind of grill them on their offering. I'm sorry, on their pro forma. This seems really high. What's that based on? Why is there such a big jump here? Well, I see that you have interest only debt for this amount of time. What's going on at the end of that? What's your plan at the end of that? I see you have bridge debt. What's happening there? If there's short-term debt, why? It's, again, not necessarily a deal breaker. I just want them to explain why. And you start to see patterns after a while. So for example, there are some operators that started getting a little ahead of their skis, and they bought more than they could manage. Because if you saw a lot of these educational gurus pop up over the past few years, you see it's super sexy to acquire deals, and it's super sexy to raise capital, and it's not quite as sexy to operate deals. So I want to know, can you operate this deal? I see that you can buy it. I see that you can do underwriting. I see that you can even raise capital really, really well. What's going to happen after the dust settles? Are you going to then operate this, or are you just going to keep buying? Like, it's, to me, at least a yellow flag if people are constantly in capital raising mode. Because sometimes you just got to do the work. And if they don't have the infrastructure to support being constantly in capital raising mode, and by the way, this is against my own self-interest as the lawyer. I want people to be raising capital all the time. That's how I make my money, right?
Right.
But at the same time, as an investor, I want to see, okay, but are you taking a pause to go and operate your deals? A big red flag, I would say, is people who are buying new deals that they maybe can't support from an infrastructure standpoint to get acquisition fees. I've seen some of that. Like, we got to keep the lights on, so we got to buy something new until this all turns around. And then that stuff starts to snowball. And I'm not even saying they're bad operators, or that they're criminals, or that they're trying to do anything untoward. That's how a lot of these things start. Even Ponzi schemes, in my opinion, probably start off as, just until we catch this up, let's just do this, right? And I don't think most people who get into this space mean to do things wrong. It's just things start to get away from them, and there's not a good plan in place for it. So I'm asking questions of, I've seen this go wrong in the future. Where are we today? Do I see the patterns that I've seen when things have gone wrong? So it's more for me recognizing patterns too. and how to identify that early.
There are, there's, I think being an investor through the last several years, if you hang out on the internet, on social media, there was a lot of, hey, I don't understand how other operators are making deals in my market pencil. And many operators, sat on the sidelines and haven't bought for 2 or 3 years. And then there are operators that have done several deals every single year. And so, from your vantage point, what is like, I have to imagine, especially as someone who also invests in these deals, that you're seeing the operators that maybe even are clients are ahead of their skis, or their incorrect assumption. Yeah, I just like, talk us through that.
Yeah, and I have seen, obviously I can't talk individually about any specific operators, but I have seen, so I've seen people ask me or our firm, how do we do a capital call? And I'm like, didn't you just give distributions? Like we didn't see that coming, you know? So I've seen that happen. And what I notice is it is the people that are just trying to kind of keep up with the Joneses, right? I mean, it is, like I said, it is sexy. And if you're out there with a certain public persona or not even, it's, you want to show your investors you're still doing deals, and you want to show your audience in some cases that you're still doing deals. And I've seen lots of really solid operators just take a minute and just say, we're not, multifamily is a good example of this, right? A lot of people took a big break in multifamily for a little bit just to let the craziness settle down and to manage what they had in front of them. And some of my best operators did that. And so those are the people that don't really care what you think if they're doing deals or not, because they care about their investors first. And that I really like to look for is, what is the integrity of my company doing? And let's take just a little bit of a break to kind of right the ship, as it were. And not saying everybody who's been doing deals, by the way, is a bad operator. That's not, some people are looking for different things, right? There are some operators that only do value add, or they're different classes. And so I'm not saying anybody who bought multifamily over the past 2 years is a bad operator. It might just be a little bit different. Not every multifamily has been a disaster either, right? I mean, plenty of people are making money. So it's, you've got to know how to discern that from anything else. Because if you're just listening to the headlines, then you're like, oh my God, this is terrible. This whole industry is crap, and multifamily is awful, and that's not true either. So it's asking the questions, but also leaning on all the other experts that I don't make all those decisions in a vacuum either. I have plenty of people that I go and say, okay, if I'm looking at multifamily, what should I be looking for? You're an operator, I'm not. You don't want me doing your underwriting ever. That is not my lane. You don't want me to do it, right? I'm not an asset manager, right? So I'm going to ask those kinds of questions. If you're doing construction, what am I looking for? So I do ask the questions too of other people as well. And it's just not being, I think the biggest thing, don't be afraid to ask questions. Don't be afraid to get help.
Do you have a common question? Do you have 100 point? I have 100 point checklist of questions that I ask to make sure I don't miss anything. Do you have something like that?
I kind of do. It's not quite as, I probably should, right? It's not quite as organized as what you're saying, right? Because a lot of it is we're asking these questions as we're helping them do the deal. And so, yes, because I need to know that, and the firm needs to know that before we even do the offering. So then in addition to that, I'm asking the harder questions about, how'd you pick your partners? And the answer better not be because I think they can raise capital, right? Like,
Tell us
I
more
don't,
about that.
yeah, I want to know, what is your expertise? What is it that you bring to the table and that you're amazing at and that lights you up and that you want to do in this deal? And then tell me about the other stuff where your gaps are. Who's filling those gaps and why? And there are a lot of times when people will partner with newbies, which is wonderful. I think that's great because you've got someone who's hungry and who's smart. And just because it's their first deal doesn't mean that they're not great. It means that it's on the job training. And I think that's great. Again, as long as it's not just because we need a whole bunch of bodies out raising capital, that's a red flag to me. If you've got a 20-person GP team where half of them are investor relations, right? And they're just all raising capital, that's a red flag. I think if you have a really solid deal and a really solid team, the money will find you. It will. And I need clients, and I need, especially if I'm investing in them, to be confident in that. So the question that I'm asking is, why your team?
Yeah. What else? Do you dig into the fundamentals of property, insurance, anything like that?
Yeah, I mean, I do. I mean, I want to know, and again, a lot of times it's not even necessarily the answer that is the deal, because they should be able to make management decisions. I'm not trying to second guess their management decisions. I just want to know that they're thinking about why they're making decisions, and then they have a good answer for me. Not that I already know what their answer should be, but how do they answer me? How do they communicate? Are they defensive? Do they have it? Did they think about it at all? If they're like, insurance, should I get insurance? I don't know. Well, okay. If you haven't thought about that, then maybe you're not quite ready to do it,
Yeah.
and I love that there are all these education companies out there now teaching people how to do syndication, because I do really love this industry. I do. They're not all created equally. Some of them are better than others, but I love that it's out there because it is helping normal people figure out ways to create wealth if they're willing to put in the work. I love that. I think real estate's a great equalizer that way. You can create wealth without coming from wealth. It's wonderful. But at the same time, some of them make me nervous because they're really just capital raising courses without any compliance behind it. And of course, that's my area, so I'm sensitive to it, right? But
Yeah, I think you could probably speak more to this this issue. Now, okay, you're an LP listening to this podcast, and you're hearing that Bethany has looked at thousands of deals, and she is the one who can easily point out, oh, there's just a bunch of capital raisers on a deal, versus, am I directly dealing with a sponsor, and are they the person who I want to partner with? Can you talk a little bit about, of course, from a securities point of view, there are people that are just raising money, maybe for a commission, which is illegal, and but as an LP who's looking at a bunch of operators and deals, they might not know the difference, and like, is there a case of why they should care, or is that really just an issue when for that person if the deal goes sideways?
I think there is a case why they should care, and it's kind of twofold. The first one if is that it's illegal, and it's if you have an operator that's cutting corners there at the beginning before they even get started, where else are they cutting corners? If they're saying, you know what, I'm going to skirt the law here because whatever, we need to raise the money, I'm willing to take that risk. Now, I do think it's okay for operators to decide what risks they're willing to take. They're all grown-ups. I give them, here are the risks. You're grown. You get to decide which ones you're willing to take, right? For me, taking that one where I'm going to violate securities laws out of the gate, that's a big one that I'm not interested in investing in. But the other part of that is, you're right. If the deal goes sideways, now you've got a couple potential issues. Maybe your deal's going fine, the deal that I'm on as an LP. You don't want your deal to get investigated. If you're an LP, that's going to make it more difficult for the operator to do anything. It's going to make it harder for you to get a return on your investment. It's kind of a tricky spot to put everybody in if there's an investigation or if there are claims made. If you have a deal, and this is the scariest part to me because you don't necessarily have the control over it if you haven't asked the questions. Let's say you and I are on a deal together as GPs, right? And we've got a couple people approach us that say, hey, if you give me a cut of your GP, I can bring in $1 million. And we're like, no, 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 no. If you're going to be on our deal, you need to have substantial duties because that's what Bethany said you have to do. We're going to follow the rules. And they're like, fine, give me some duties. I know how to do this. I know how to do that. I'm going to follow the rules. I want to be on your deal. I'll also bring $1 million. Jackpot, right? No, because that person more than likely is a sponsor on other deals where the person didn't make them have substantial duties, meaning they were just a capital raiser. Now, if they get investigated, guess what? Every single deal they're on has the potential to be investigating, including ours. So we did everything right, except let that person come on who's not doing it right on other people's deals. And now you're screwed because you did everything right. And because someone else cut corners, you're getting investigated. So you better hope that everything is exactly buttoned up.
How often does that happen?
I'm going to guess that it's only when deals go south well, not guess, that is when it happens. It's when deals go south, but no one ever thinks their deal is going to go south. And so this is one of those things where I tell my clients, this is your risk. You get to decide how much risk are you willing to take, right? And in 21, people were like, whatever, everyone makes money. We're going to get 30% returns, right? 22 hits and they're like, oh man, right? We're all losing money. Our loans are, the interest rates are going up and we don't have the cap rates, all these things, right? So how often does it happen? Probably as often as an investor gets pissed off that they've lost money and they want to have your life be difficult and they call the SEC. That's when it happens.
Okay, so basically in market cycles.
Yeah. Yeah. And is the SEC on its own looking for these kinds of things? No, probably not, especially now, right? Everybody's getting their jobs cut. So not now, but investors though will make the calls. I've seen it happen. They're like, okay, fine. I'm losing money. You're going down.
Yeah, I'm involved. I've invested in the ATM deal that went. I mean, that is allegedly a. I don't know. It went sideways.
Yeah.
Maybe it's a Ponzi scheme. Verdicts out. And uh, multiple people have reported that deal to the SEC, and I think if you want to look this up, you can look up articles about the ATM guy getting raided by the FBI, his offices, and the whole nine. And I think there's this question about like, okay, if a deal goes south and you report someone to the SEC, does anything actually happen? And it feels like the sentiment, I mean, there are people that get caught, but it takes a long time for anything to happen. I imagine you're much closer to understanding how that type of thing works.
Yeah. I mean, it can take a long time. We're still talking about government agencies. We're still talking about if in a market where lots of deals are going sideways, they're getting a lot of calls, right? And so they have to pick which ones are the ones that are going to be worth our time. Which ones do we think we can actually uh, make an impact on? Where do we think we can maybe recover something? And so there's a lot of things that go into it. But I can tell you that operators are typically still appropriately fearful because you don't know if it's going to be you. And so why take that risk? Why take the chance, right? Of not doing things when the cost of compliance is not that much in the grand scheme of things. And frankly, if your deal doesn't pencil, if you add in compliance costs, it's probably not a good deal and you shouldn't do it. You know, so, and we're not talking about $50,000 to $100,000. We're talking about $10,000 to $15,000. So if your deal doesn't pencil with that, I don't even know what to tell you about the deal. So there's that, but there's the threat of even, it's like an audit. Maybe your taxes are right, maybe not, but you have to deal with an audit. That's expensive. It's stressful. It's time consuming. And maybe at the end you're fine, but you still have to go through the audit. Same thing with an investigation. You're turning everything over. It's really scary. I think that right there is a deterrent to doing things that might get the SEC called on you. And sometimes investors, they're just mad and they call to make your life miserable, even if they know you didn't do anything wrong. And that sucks. But the SEC, they're pretty smart. They typically know those are the times when maybe nothing happens. Right. And so you've got investors who are like, nothing ever happens. Well, you called because you were pissed off. There's a lot of leeway for how people can manage these deals. It does take a lot for there to actually be a violation. The PPM that we do, that the investors sign, staves off most complaints other than really horrific behavior on the part of the manager or the operator, right? For this exact reason. You don't get to second guess whether or not an operator should have fired the property manager, or you don't get to second guess whether they should have refinanced then or waited, or, you don't really get to do that. You do get to second guess if they took your money and they paid a distribution to somebody else with that money. That's worthy of a call. And so it's the SEC has to weed through, is this just a pissed off person who's not that sophisticated? Or is this like a legitimate thing? And sometimes that takes some time and resources.
So the takeaway here is if you're an LP, actually knowing if you're the operator you're talking to, or maybe it's a capital raiser, investor relations person, are they actually a part of the team? Is this person I'm talking to intertwined with multiple different operators? If so, what is that structure? And like, could be hair on an investment if it goes sideways.
Yeah. Yeah. And so we say passive investing, but it's not really that passive because you really do need to do a little bit of work at the front end. Although once you find an operator that like, and trust, you can keep going with them because you've already done all that diligence.
I imagine you have some pretty good stories of operators who you may have liked or worked with and thought had their ducks in a row when you started working together, and those who, you learned something along the way. What would be examples of those that LPs can listen to just have their spidey senses up as they're talking to figure out who to partner with?
Yeah, I think honestly, the best thing to do is ask the hard questions out of the gate and just look at how the person responds. That's going to tell you most of what you need to know right there. And I know that's sort of a soft answer of like, listen to your gut, but it's worked for me most of the time. So if you ask people who they are, they show you. And is this, if I ask a question and I don't like how I'm getting the answer, I'm going to move on because that's how the person communicates. And if it's not comfortable for me how they communicate, or if it's not comfortable with me how they deal with conflict, then I don't want to deal at the beginning when everything's beautiful and wonderful and you're going to make a gazillion dollars and, all the things. If I don't like how they're behaving there, to me, that tells me everything I need to know. So I think you don't even have to know all the insider tricks to know, can I deal with how this person communicates and how they respond to my questions? If they're like, oh my God, you idiot, I don't need to tell you that. If you knew anything, you wouldn't be asking me that. Move on to somebody who can deal with a first time investor then, or maybe move on to somebody who's just more aligned with your communication style or your ethos. I think that's probably the most important thing. You don't even have to know. You don't have to know the dirt. You just have to ask the questions.
Yeah, and these questions can be as simple as like, why do you think it's gonna sell for this, or why do you think
Yeah.
why is your insurance premium that?
Yeah. Yeah. And why did you make these assumptions? Because let's face it, they're all educated guesses. So where did it come from? Did it come from you just want to make sure you show this much of a return? Because you can do that with manipulating, rent increases or cap rates, or you can do that. And so you should ask those questions of where did you come up with that number? What resources did you consult? What assumptions did you make to come up with that? Explain to me, like I'm 10, of how you decided to do that and see what they say.
I love it. What are the various types of asset classes that you've invested into? I imagine you see everything under the sun, and there's, some that are more interesting than others. I've heard of boutique hotels is something that's like a new niche
My
that's coming
favorite.
out for
Yeah.
me.
Yeah, that's my favorite. I'm passive in mobile home parks, in self-storage, and in commercial mixed use. I'm actually not in multifamily, believe it or not. Don't read into it. It's just, there's no reason. It was just at the time, I was like, oh, I picked these deals because they were right in front of me at the time. I wanted to do it or whatever. And then I started becoming active. And so I put my money into my active deals or deal. I love short-term rental, but when I started looking at boutique hotel deals, I fell in love. And the reason that I fell in love personally is my background actually is from the operating company side. And in a boutique hotel, there's typically an operating company in addition to the real estate. Maybe a restaurant, or a bar or a spa or whatever. And in my mind, I love that, even though it does add a layer of complexity. And a lot of real estate investors are like, no, 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 I want this and I want rents and I want it to whatever. They're afraid of the operating side. I like that because I feel like we can get more creative with lines of revenue to create more cash flow. So yes, it's more complicated, but I also think you get to get a little bit more creative with how you create cash flow. So that's why I like it personally. I'm not afraid of the operating side because I've been there and I've worked on that side.
Interesting. So boutique hotels, this concept is more of like it's short-term rental, like maybe not even short-term rental, it's
Yeah.
hotels plus some sort of restaurant or I guess first floor layer
Yeah.
that
Sometimes.
provides the sometimes.
Yeah. Yeah. Not all boutique hotels have restaurants and bars. And I know people that will invest in them only if they don't, right? Because they want the simplicity of short-term rental and they want the uniqueness or whatever, but on a bigger scale, right? Boutique hotels, maybe it's got 10, 20, 30 rooms versus 4 bedrooms. Right? And so people like it that way. I like it when it has I want to be able to build something into a 4 or 5 star resort. So you've got to have a spa and a restaurant and a bar for that, but they don't necessarily always do.
Yeah, and are you of the mindset I want to go deep in a couple things, or I wanna be diversified across a bunch of different asset classes, and where are you at on that journey?
When I'm passive, I want to diversify. Actively, I am doubling down on resorts. So I'll say boutique hotels, but not just boutique hotels. So the fund that I'll be launching here in probably the next 2 weeks or so, I have to figure out where we are on the docs actually. In the next 2 weeks is a luxury resort fund. So it could be a mansion where people can host amazing retreats. It could be a boutique. It will be also a boutique hotel. It could be a castle, something where you can have unique experiences. So that's what I'm doubling down in. But I know a lot of people have gone the other way where they're like, I'm going to create a fund and we're going to diversify across 3 different asset classes. Nothing wrong with that. It's just not, I want to focus because I'm also running a law firm as well.
Yeah. What made you wanna go dive into doing an active deal?
So I was working with a coach and we were doing my visioning and it was sort of this, we call it my CEO org chart. And I was like, all right, what's my top vision? What's my goal for my extraordinary life? And at the top of it was like, you know what, when I retire, I want to host amazing retreats at beautiful locations at properties that I own. That's the retirement plan, right? I'm not young. So I was like, we should probably start looking at this, right? I'm not retiring yet, but I'm not young. So I was like, all right, I'm just going to put the feelers out there. And I called, I think you know him, David Kafka. And I said, David, he lives in Belize and I know he invests in Belize. And I know a lot of our community, especially the real estate guys community, invest in and do retreats in Belize. So I was like, that'll be my first call. So I called him. I was like, just be on the lookout for places where I can host retreats to teach people how to scale their businesses, teach people how to create wealth using real estate, all the things that I'm already talking to people about anyway. Right. But I want to do it in person, with my toes in the sand. And he said, actually, I have an off market deal right now. And the seller doesn't want to list it. He needs to move back to the States. He doesn't want to list it because he doesn't want to spook the employees. So I was like, all right, I'll come look at it. I went and I looked at it. I met the seller. I met the staff. I fell in love. And I had, as a lawyer doing her first deal, I had like 7 months of free diligence to do because nobody was bidding against me because it wasn't listed and he wasn't in a huge rush. So I had all the time in the world to just dig into the diligence, right? Which is just a lawyer's dream. And I was working on finding my partners and all of that, and I fell in love. But then I had to do the numbers because I would not buy a property based on, oh my gosh, I love it here. So we did the numbers, and I will never forget. Can I swear on here?
Yeah, sure.
I had this woman help me do the numbers, and she came from the big few accounting firms, and her answer to real estate is almost always no. She doesn't like alternative investments. She's like a stock market lady, and she looked at it and she said, Bethany, if you build the 6 new tree houses like you said you were going to, if you add 6 new resorts, all the things that if I execute my business plan, she's like, this thing cash was like a motherfucker, and I was like,
Yeah.
that is my new metric for deciding on deals is it has to cash flow
Yeah.
like a motherfucker. So I was like, I'm in, and the rest is history. So I didn't mean to buy a hotel right away. It was sort of my someday plan. And, it worked out. And we're actually about to take that full cycle in under 2 years.
Why do you think some choose to stay as an LP versus go active? I find that maybe we should report back after you've been active for a year or two
Yeah.
that I could just eke out a little bit more return if I am the operator in the deal and moving from passive to active. Yeah.
I think one of the biggest deciders, when you get into just real estate syndications, you typically have time or money. And if you don't have both, then you're just going to contribute whichever one you have. And so if you are a high income earner, for example, who makes a lot of W-2 income, you might not have the time to be active in a deal if you don't hate your job and you're not trying to get out of that job. Passive works for what it's meant to do, which is to create another line of revenue for you without you having to work for it so that you eventually can leave that job and have your money working for you. Some people are fine with that. You know, hey, I love being a plastic surgeon. I'm making a ton of money right now, and my money's over here working for me while someone else is dealing with tenants and toilets, and I don't want to deal with that. So I think that's a lot of times why people stay passive. They don't want to deal with it. A lot of times when people get active, it's because they didn't have the money to start with, and what they had was time, or at least the ability to put in the time and the effort. And I think that's also one of the reasons why I love real estate so much is because I didn't come from money. I was like, what? I can work hard. I know I can do that. And even when I started practicing law, that's why I was passive first, because I was like, at least now I was making money. I was passive first, but it's kind of like, I can coach or I can play. And I was like, I had a chance to play. And hotels is, I say this a lot of times now, if I could go back and talk to my like 19-year-old self who was in college, I'd be like, go into hospitality. It is your calling. When I'm there, I love talking to the guests. I love talking to the staff. I love coming up with the menu. I love it. So for me, it's like I'm making money at this hobby that I have. So that's why for me, I think going active was good. It's easier than practicing law, in my opinion.
Yeah.
Easier.
Yeah, I find that people will switch to it because they think it's interesting, and I think it only makes sense if you plan on continuing to build a career. I don't think if you do a one-off, I think you pay too much when in learnings your first go around to do it in a one or two off.
Not making a ton of money on this deal. And I knew that, right?
Yeah.
Because I had to get enough partners to help me. So I'm sharing, right, with it. And we build it up with a value add. Although, like I said, we're about to take it full cycle better than what we anticipated. And the plan was always to get it up to a certain valuation and then sell it into a fund that I also operate and then go buy more. So I was testing, make sure that we did it right. We did, and now the fund is coming. And so I'm actually buying it myself into not me, I'm going to syndicate it, but into a fund. And then my investors can choose to take their money and run with a nice return. or come into the fund and let's do it some more. So for me, I think you're right. Doing it just once, the learning curve is really steep if you're not going to keep doing it.
Yeah, absolutely. One other topic I'd love to dig into, because I just think from as someone who's seen a lot of deals, I don't think there's any. The number one thing I say that I think helped me become a better investor, that I learned when I worked at Techstars, a venture capital firm, and I think the same thing applies here, is the more deals that you see, the better understanding of the landscape that you have. And you can understand the nuance of like, oh, this is an outlier. So you are someone that has that perspective. And uh, I would love to understand, we talked a little bit about the roller coaster of the economic environment, between 2020 and today. So give it the last 5 years. How has the structuring of funds and deals changed over time?
So what we see is, depending on the strength of the market, right now I'm seeing higher preferred returns, for example. So we're giving investors a little bit more upfront to keep them comfortable. Like, hey, don't worry, you're getting paid before I do. I do feel the need to say too, when you're talking about preferred returns, that's still not a guaranteed return. Well, it's still a risk,
You
but
might
what
not even get it
you might
your
not ever
first
get
year.
it.
Yeah.
Yeah, and probably right away you won't. They'll accrue a lot of the time. What I always tell people is the only guarantee is if there's cash, you're getting yours first, right? If there's enough cash, you're getting yours first. So we're seeing a little bit higher preferred returns. Investors can kind of demand that. We're seeing a little bit more in debt funds come up because the debt market is a little bit messy right now, and so people are like, okay, what can we do to provide that debt for deals? So a little bit more of that. I think we're seeing too, um, a little bit lighter in fees, just, depending on the asset class too, by the way. So it just depends. You're probably not going to get, huge acquisition fees right now, because everyone's trying to like keep investors' money flowing and like, okay, don't worry, we're going to meet you in the middle here a little bit. I've been seeing a lot more of a waterfall. And what that means is just the sponsors are saying, okay, investors, we're going to front load you. But once we've proven that we're going to get you to a certain return, then we're going to flip it and we're going to start taking a little bit more. So again, you're getting yours first, but we're still going to get ours because we believe in this deal enough that we're going to flip it. And so we'll see something like, hey, once we get you to a 13, 14, whatever percent annualized return, we're going to flip it to a 50-50. We're going to share more equally in the returns. A lot more of that. And that makes investors feel warm and fuzzy that you believe in the deal enough that you think you're going to get to that point where you're splitting 50-50. So it's a little bit more of a complicated structure just because you're taking a couple of steps. But I really like it because it lets investors know that you're in it with them. The other thing that we've been seeing a lot more of, and this could just be that we're educating people that they can do this, because a lot of people they're like, oh, I didn't know you could do that. You can have more than one class of investor. And a lot of people, it's shocking to me how many people don't know you can do that. And then I realized, okay, I've been looking at thousands of deals and you can actually do almost anything you want as long as you tell your investors what you're going to do and they buy it. And I like the idea of incentivizing people to put in more money. So, hey, if you put in more than 250 or 500,000, we're going to give you a higher preferred return or we're going to pay you first. Those kinds of things. So we're seeing a little bit more creativity in deals. I mean, for a while there, it was like everybody's just, you know, 8% pref, 80-20 split. You get what you get, and now it's like, well, it depends on the asset class or it depends on where we are in the cycle and that kind of thing. So we're seeing people take a little bit more care in structuring their deals. And to me, that is the sign of an operator who's really digging in and trying to figure out what's going to work for the market, for their property, for their team, and for their investors. And all of those things have to be considered. I would even say it's a yellow flag to find an operator who's only looking at the investors and not the other things. And the reason for that is that if you have no incentive to do a good job, that gets old real fast if you can't pay the bills. And your investors need to see that there's some incentive for you to keep doing this, even when it's hard. So I would say, even as an LP listening, don't be lured in by people going, we don't take any fees and we give you everything and don't worry. And it's like, till when? When does that start getting tiresome? Because you got to pay your bills too. So I is a little troublesome to me when people say they take zero fees at all. And then there's like this high pref and whatever. That tells me that they're afraid that they can't raise the money. And so there's a balance there. I'm not even sure that's the question you asked, but I thought of it.
No, I love hearing, just letting you rant, because I think this is all nuggets, nuances. These are the nuances.
Yeah.
Are there this concept of multiple share classes? The way I've seen these play out are hey, if you are class A, you just get, the pref 10% cash flow and you get no upside. And then if you're in the other classes of the deal, you get less cash flow, but the equity upside. Is that typically how you see these types of deals structured? And I think as an investor myself, I don't have a good opinion about if that's good or bad, or what are the drawbacks, or does this actually make this deal safer for me, as the class B shareholder? I think inherently, if there's someone that's sitting ahead of me getting the cash flow, that makes the deal less safe for me. And maybe that's not true, but can you talk a little bit about that?
Yeah, I mean, that is pretty typical what you just described. That is a pretty typical, it's kind of one or the other. Usually, like you get pretty good cash flow and you're in it for the cash flow, or you're holding out for the upside, but you ultimately should, all things being equal and all things going well, get more. It's a little bit riskier because you're coming after somebody else, right? And you're waiting a little bit longer, so it's a little bit more patient capital. To me, the bigger thing is knowing what your investors' investing goals are and having a solution for them to see if it's a good fit. Some investors, let's say older investors, for example, or people who are just trying to preserve their wealth, typically want a little bit more cash flow and they're not waiting around for upside. They'll take the slow and steady 8 to 10%, right? Somebody who's patient is like, yeah, I'd like to see like 15 to 20, 30, more, whatever, depending again, if it's a development deal or if it's multifamily or whatever. I think knowing what your investors are looking for and providing, for lack of a better word, a product for them is really, I think, insightful, and it is a good way to approach investors, but also having underwriting that can support that. So if you tell me, I'm somebody who likes the upside. That's me. I like upside. I can be patient because I don't need the cash flow. So for me, though, I want to see your underwriting. Like, what are the odds we don't get there if people are getting paid ahead of me? So that's what's really important, that you understand and pick apart the underwriting of, okay, is this just pie in the sky? Even the waterfall, by the way, even the waterfall, if you could have a waterfall that says, once I get you to an 80% return, we're going to, skip it to 80%. Well, are we really going to get there? Like, what's the likelihood we're really going to get there? Show me how you think we get there. So that's when you need to dig in and ask the hard questions about, what are your assumptions? At what point do you think we get there? And, I also like being in the same boat as the operator. Like, I want us to be aligned and I want our goals to be aligned, which is why I like the upside. I want, if you win, I win, kind of thing. But I need to know though that your underwriting's not garbage first, because it's easy to say.
Is there a requirement for you? So, a question that I think about often is, if does the operator need to put their own money into the deal? And when I say their own money, can that be generated from fees? Basically, can they take fees on the deal and that's their co-invest, or do they need to put their own money in the deal?
Well, legally speaking, they don't need to put their own money in the deal. You don't have to. The split on the sponsor side is for their sweat equity. That's for the work, right? So there are a lot of investors that won't invest unless the sponsor team puts their own money in the deal. I have a different opinion on that. Having grown up in the venture side, seeing how a lot of folks were like, I have this brilliant tech idea and no money. I can't get funded because I don't have the money to put into a deal. That leaves a lot of really good companies struggling for no good reason, a really good founder struggling for no reason. Real quick sidebar or little side story, and I'll come back. I was working with this founder team, and I was talking to some folks in the private equity space, and they were with a venture fund, and they were talking about the woes of, in between trust payments, how they had to couch surf until their next trust payment hit. And I get it. I've been there. I've slept on couches until I was waiting for my truck. And I'm just like, gross, because I'm like, I did not know where my next meal was coming from some days, because I was in college and eating chips and salsa when I worked at a Mexican restaurant, for that was my meal. So like, we are not quite the same. And that guy said to me, if a founder can't come up with $25,000 to put into their own deal, then they shouldn't be in business. And at the time, I was still a young lawyer. Like, I don't have $25,000 to spare right now. That doesn't mean that I don't have good ideas. It doesn't mean they don't have good. So I have a really strong opinion on whether someone should be forced to put money in a deal when they're getting started, and if their work is good enough. I think if you have an operator who's hungry, you might get better work out of them than if they have $25,000. So I don't think that an operator should have to put money in. That said, if they do have investors that are going to require it, absolutely you can take the fees that you've earned and you can roll that in to the deal. And then you sit in the same seat as an investor. though, right? They get the same returns on that 25, 50, whatever $1,000 as the investors do. And they sign they sign a subscription agreement, they do all the things, and they sit in the seat of the investor for that money. And then over here, they're earning their money for doing all the work. It's two separate things. And that's typically how it's done, but I feel very strongly about that, just knowing kind of where I came from and this whole like we get into real estate because you can start without having a trust fund, you know. If I wanted to go into venture, I would have gone into venture.
Absolutely.
So that's my rant.
Bethany, you have a book that just came out that's a bestseller. Tell us about it.
I do. It's called The Power of OPE, Other People's Everything. As you've heard me talk about, I make most of my money off of other people leveraging OPM, other people's money. And I'm sure everybody listening has heard of OPM if they're listening, whether it's from Rich Dad Poor Dad or somewhere else. It's been around for ages. And leveraging OPM is, in my opinion, one of the very best ways to create wealth. But what I've learned in advising these thousands of people that I've advised is that's not enough, right? Just the money's not enough because you're going to just get yourself into trouble if that's all you've got. And so I started thinking about that and I came up with this sort of concept of other people's everything instead of OPM, OPE. And I started writing down the words and writing stories down and it turned into a whole book. And finally I got it published. So it was just released last week. So it is everywhere books are sold. And we
I
did hit
love
the
it.
list. I'm pretty excited about that. Yeah.
Hell yeah. And where can people follow you, learn more about you, and get on your list?
The easiest place to follow me is on Instagram, Bethany_LeFlam, because all the things that I do are there. So there's the link tree and you can find all the things on Instagram.
Love it. Um, Amazing. So thank you so much, so much for joining us today.
Thanks for having
This was
me.
awesome.
Thank you.
Cool. If for those of you listening, if you are serious about investing passively and want to make sure you're legally protected, be sure to join us next Thursday and every Thursday for more actionable strategies and insights on the Passive Income Playbook here on the Best Ever CRE show. If you've enjoyed this episode, please subscribe and leave us a review. Your feedback helps us continue providing valuable content and reaching more investors like you. And with that, thanks for tuning in, and we'll see you next week for another episode of the Passive Income Playbook.